Chevron hosting its Investor Day right here in New York today. And joining us ahead of that is Mike Wirth. He is Chevron's chairman and CEO. Mike, thank you for coming into set today.
Welcome.
There are a lot of things that Wall Street wants to hear from you today. I think they're looking at updates on the Hess acquisition that was announced in July. And really, your plans for growth, because 6 months ago, people would look at it and say there's not a lot of places for growth, but the table has changed drastically. There are a lot of places that you've got things to work on and that you are going to be showing growth. So what is your message to shareholders today? What are you going to be leading with?
Our message is Chevron is bigger, stronger, and better than ever. We're going to be growing free cash flow and earnings through the end of this decade and beyond. Free cash flow will grow at a 10% compound annual growth rate, underpinned by a strong portfolio. We've got a track record of growing shareholder distributions over the next 5 years. At a $70 oil price, we could return 45% of our market cap to shareholders through dividends and share repurchases. So we've got a strong story of capital discipline, cost discipline, steady growth, and cash returns to shareholders.
Yeah, earnings per share, you're looking at growth better than 10% annually if Brent stays above $70 through 2030. I guess let's start with that assumption. $70 is above where oil prices are today. I think 65 is the latest on Brent, just under that, 64.48. So what gets you to $70 when you look at the global supply out there?
Well, we're seeing the current market weighed down a little bit, but primarily by the return of OPEC plus barrels that have been held off the market. And so prices, as we move into 2026, are likely to reflect that additional supply. You get beyond 2026 and things come back into balance. And so this is a guidance out to 2030. And I think it's reasonable over that period of time that we're going to see a recovery in commodity markets. And 70 is probably a bit of a conservative assumption if you're looking out through the end of the decade.
What happens if oil prices are lower for whatever reason? How do you change your assumptions?
Our break even to cover our capital spending and our dividends will be below $50. So we're well positioned for a low cycle. Even at a $60 price, our free cash flow, if you look at last year versus the coming year, will triple from 2024 to 2026 at a $60 oil price. So our underlying portfolio strength and growth is resilient even in a low price environment. Of course, we've got a AA credit rating, so a very strong balance sheet that we can lean on if it were to be a longer cycle.
You're actually now talking about reducing CapEx through 2030 with a reduced range of $18 to $21 billion a year. But I think you're planning on increasing production even with that lower CapEx.
We're growing production at a 2 to 3% compound annual growth rate. Demand in the world is growing at about 1%. So we're growing a little bit stronger than overall demand is. At $1 billion a year less capital spending. We also announced $1 billion in further cost cuts. We increased our synergies on the Hess transaction by 50% from $1 billion to $1.5 billion. So continued cost and capital discipline are necessary in this industry, and the plan we're laying out delivers that.
The world is changing so much, Mike, and I always talk to you about the same thing. You know, I always thanks for still looking for oil through all of the travails of the last decade. I would say there was a time when supposedly shareholders wanted return of capital, or there was pressure, we were talking proxy firms, pressure to change your entire business to some other form of energy. People actually thought that might be a good idea. I think things are turning back the other way. I think the worm is turning to some extent. Have you changed? Did you, any mistakes made trying to go that route a couple of years ago that you've reversed? Are you increasing plans for fossil fuel production differently than you would have 5 years ago? I just bring up the Ford F-150, the greatest selling vehicle in the United States. They aren't making them EVs. They're pausing with no plans necessarily to restart and possibly cancel the whole idea of an EV.
For internal combustion engines.
The best-selling vehicle in the country.
Yeah.
Bill Gates, I mean, just a lot of things have, not that he ever knew anything, but the worm seems to be turning. Have you changed anything?
We never,
you never went along
bought into some of the dire projections that were out there. This morning, the International Energy Agency has issued its updated report where they now have what they call their current policy scenario, which shows demand for oil and gas growing to 2050.
2050?
2050. So we
growing
see,
from here?
decades and decades of growth in demand for oil and gas, which is what we've always maintained. I was in front of a congressional hearing several years ago where I was asked to pledge that we would never produce more than we were at that point in time, and I refused to agree with that.
Who
because
wanted you to do that?
We have to meet demand.
Whose idea was that?
It was Congressman Khanna who asked me that question and said, would you pledge to never produce more than you are today? And we have to meet the demand in the world. We actually supply the energy that keeps things going right outside your window.
How much do you have in carbon capture, that kind of stuff? Are you in?
We actually have a carbon capture project in Australia. That
without subsidies, does that make sense?
Well, it was part of a broader project. This is a gas field that has CO2 in the gas, which we can extract.
Does it economically make sense?
It was part of developing one of the world's largest LNG projects.
But does it make sense?
It does in that particular
even without
instance.
subsidies.
In that case, it does. But look, we've seen the policies slow down. You got to have customers for these new products, and customers have been slow to come for green hydrogen, for carbon capture. So investment is slowing in a number of these technologies.
But interestingly, in China, there's no slowdown in EVs. I mean, that's the other thing.
Or coal burning.
China's got a different economy than we do.
Right.
They've got a different way the government participates in investment decisions and industrial policy in China. You have to.
So do you think they've made a mistake? Do you think that they should have not pursued the EVs the way they have?
Look, they've got a plan to control critical minerals, solar panels, electric vehicles, and so they've got a state-driven plan to have a dominant position in a number of critical technologies, and I think they're effectively
They just want to win,
pursuing
but
that.
at the same time, they're polluting. I'm not going to say polluting, but they're spewing emissions through coal plants and building coal plants.
Sure, they're building more coal plants. They've got more coal-fired power capacity than the rest of the world.
The one hand's doing this, the other hand's doing
and they're continuing to build more in China.
Yeah.
Hey, Mike, talk about new business lines. You are in the business of now talking to some of these AI companies about building out data centers that are powered by natural gas. How did this come about? Where are these discussions taking place? What should we be watching?
Well, you've talked a lot about the demand for power. GPUs and power are the two things really constraining the growth right now of data centers to support AI. We have abundant energy resources in this country. We're in the queue for 7 of GE Vernova's largest turbines that begin delivering next year for gas-fired power generation. We've got a site identified. We've got discussions underway with one of the large customers who you talk about every single day here, and are moving towards a world-scale facility to generate power off the grid that would not compete with consumers for electricity, would not have to go through a grid that's already constrained, but really be set up to deliver just to data center customers. We're making good progress on that, and the demand for it from all the hyperscalers is only going up.